Welcome back to Talk Tickers. You know, there's an old saying on Wall Street that goes something like this. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. And usually that weighing process, finding the true value of a company, that takes months, maybe even years. But yesterday, we saw the market try to vote and weigh a company all within the span of about, 6.5 hours?
It was incredibly efficient, I'll give it that.
Yeah.
A full boom and bust cycle. You had the euphoria, you had the despair, all before lunch. It was really a masterclass in market psychology.
We are, of course, talking about the auto parts sector, and specifically, the ticker of the day is AAP, Advanced Auto Parts. And before we really get into the weeds of the numbers, we have to set the scene for you because context is just everything here.
It really is.
It's Saturday, February 14th, 2026. So happy Valentine's Day to everyone out there who loves balance sheets more than chocolates.
Or, maybe to those who need a good distraction from the chocolates.
Exactly. While the rest of the world is worrying about dinner reservations, we are here dissecting what happened yesterday, Friday the 13th. A superstitious date, maybe, which is kind of fitting for a company that has been through a bit of a horror show of a turnaround for the last couple of years.
That's putting it mildly.
We're covering their Q4 fiscal year 2025 earnings. And I have to start with the price action because if you were watching the tape yesterday morning, you might have thought you were, hallucinating.
It was a classic pop and drop. I mean, you rarely see it this clean, and you almost never see the sentiment shift so violently based on a single conference call.
Okay, so let's replay the tape for everyone. It's 8:00 a.m. The press release hits the wires. The headline numbers cross the terminal. What did the algorithms see? What was the first thing they reacted to?
They saw a massive profitability beat. You have to remember, the algorithms are pretty simple creatures. They're just looking for a beat or miss relative to the consensus. And on the bottom line, Advance posted adjusted earnings per share of 86 cents.
86 cents?
Yeah.
And the street was expecting?
The street, the analysts who cover this for a living, was only expecting 41 cents.
Wow. That is massive. That's more than a double. It's 100% beat.
It's huge. And, if you look at the GAAP numbers, the real unadjusted numbers, it's even more stark when you compare to history. You remember Q4 of FY2024?
Oh, that's right. I remember. It was a disaster.
They posted a loss of over $10 a share.
Right. That was the quarter they wrote down everything but the kitchen sink. Just a complete reset.
Exactly. So you fast forward to yesterday, and they post a positive 49 cents GAAP EPS. So on a headline basis, they went from an absolute disaster to, real profitability. The algorithm saw this, they triggered the buy orders, and the stock just ripped. It
really did. And the pre-month AAP was up nearly 9%. It was trading up near $64 a share. It looked like the long-awaited turnaround had finally arrived. The shorts were covering, the bulls were taking a victory lap.
And then the humans woke up.
They opened the actual PDF. They started scrolling down. They read the cash flow statement. And then the management team started talking on the conference call. And slowly, just painfully, that 9% gain just evaporated.
It was brutal to watch. By the time the closing bell rang on Friday, that entire move was gone. The stock actually finished in the red, down about 0.5%, sitting right around $57.93.
That is such a brutal fade. To give up the entire move and then some, that tells me the market saw something it really did not like once it started reading the fine print.
It does.
It tells me that the headline number, that 86 cents of profit, was maybe a bit of a Trojan horse.
Precisely. And that is really our thesis for this deep dive. We need to explore why the market sold the news. Because on the surface, this looked like a turnaround story that was really gaining traction. But when you dig in, you have to ask yourself, is this a value trap with a leaking balance sheet? Or is this just a misunderstood recovery that requires, a little more patience?
Okay, so let's unpack this. We have a ton of ground to cover. We need to talk about margins. We have to talk about the supply chain. And we definitely need to talk about cash. But let's start with the pop. Let's start with the good news. Why did the market get so excited initially? It wasn't just that EPS number. It had to be the margins, right?
The margins were, they were effectively the star of the show, at least for the first hour or two. If you're an investor in any kind of retail, you live and die by gross margin. It's the difference between what you bought the part for and what you sold it for. Pretty simple.
And what was the number?
Advance reported an adjusted gross margin of 44.2%.
44.2. Okay, for context, where were they last year at this time?
Last year, they were at 39.0%.
Whoa. Okay, hold on. In retail, I'm talking grocery, auto parts, clothing margins usually move in basis points. 0.1%, maybe 0.2. A move from 39% to 44% is a 500 basis point jump.
520 to be exact.
That is unheard of. I mean, that's like a sprinter suddenly running the 100-meter dash 3 seconds faster. How on earth did they manufacture that?
It's a layer cake. And you really have to slice it into 3 parts to understand it. One layer is just, stopping the bleeding. Another layer is actual hard work. And the third layer is, well, a little bit of accounting luck.
Okay, I like a good layer cake. Let's start with the luck. I'm looking at the notes here and I see the acronym LIFO. Last in, first out. I feel like every time I hear LIFO, it's because a company is using it to lower their taxes, but here it somehow helped their earnings.
Right. So let's unbox LIFO for a second because it confuses almost everyone, but it is absolutely critical to understanding this earnings beat. In the auto parts world, you have thousands and thousands of parts sitting on shelves, rotors, batteries, spark plugs. LIFO is an accounting method that assumes the part you sold today was the one you bought most recently.
Okay. So if I sold a battery today, the accountant assumed I bought that battery yesterday, even if the physical battery has been sitting on the shelf for 6 months.
Exactly. Now, think about the last 2 years. Inflation was rampant. The price of lead, steel, plastic, it was all skyrocketing. So under LIFO, the most recent part was very, very expensive.
Right.
So your cost of goods sold went up and your profits got crushed.
Yeah.
That's a big part of what happened to them in 2024.
But now inflation is cooling.
Correct. In 2025, the price of commodities stabilized. The price of shipping containers from China came way down. So that last in cost wasn't nearly as high as everyone expected. They actually had a LIFO benefit, or rather a lower than expected LIFO expense. The expense was only $56 million.
And because that expense was lower than forecast, that money just flows straight to the bottom line.
Precisely. It's not necessarily that they sold the battery for way more money. It's that the accounting assumption of what that battery cost became more favorable just due to microeconomics. So that's the luck part, or, at least the macro tailwind part.
Okay, but they can't rely on luck forever. You mentioned stopping the bleeding. What's that about?
Right. So this is what we call the lapping effect. Last year, their numbers were just destroyed by restructuring costs. They had these massive write-downs on inventory they couldn't sell. They had supply chain penalties. They were one-time disasters.
Yeah.
So just by not having those disasters happen again this year, the margin automatically looks way better. They calculated that simply lapping those atypical items from last year gave them a benefit of about 280 basis points.
So more than half of that massive margin jump was just not shooting themselves in the foot again.
Essentially, yes. It's cleaning up the mess. But, we have to give credit where credit is due. There's a third layer here, and that's the actual operational improvement. Management cited strategic sourcing.
That sounds like corporate buzzword bingo. Strategic sourcing. What does that actually mean? Are they just, yelling at their suppliers more?
A little bit of yelling, I'm sure. But it's mostly about consolidation and leverage. Think about a simple brake rotor. Advance used to buy brake rotors from, let's say, 5 different vendors. That means 5 different contracts, 5 different shipping routes, and, frankly, 0 leverage. You're a small fish in 5 different ponds.
Right. You're not that important to any one of them.
Exactly. And now they go to one massive manufacturer, maybe in China, maybe in Mexico, and they say, look, we are going to give you 100% of our volume, all of it. But in exchange, you're going to drop the price by 15% and you're going to improve the payment terms. That is strategic sourcing. You stop being a passive buyer and you start acting like a true manufacturing partner with real leverage.
And that ties into the merchandising excellence pillar they talked about. They threw out a really big number. 100,000 new SKUs launched in 2025.
100,000, yeah.
That sounds impressive. 100,000 new products. But does just adding more stuff to the shelves actually move the needle, or does it just create more clutter?
It does if it's the right stuff. And this is the key. In auto parts, availability is king. They mentioned specifically improving their store availability to the high 90% range. It used to be down in the low 90s.
For the listener who isn't a mechanic, can you explain why that gap matters so much? Low 90s versus high 90s, it sounds small.
It's everything. If you walk into a store needing a water pump for your car and they don't have it, you don't say, oh, well, I'll come back on Tuesday. No,
Yeah.
You pull out your phone, you check O'Reilly or AutoZone, and you leave. You never come back. That lost sale is gone forever. So Moving availability from, say, 92% to 98% doesn't just increase sales by 6%. It saves the entire customer relationship.
They specifically called out the brake category. They said it went from negative comps, so shrinking sales, to strong positive growth. And they credited something they called left and right matching. What is that?
This is a great and kind of embarrassing example of how broken things were. Apparently, Advance had this systemic issue where their inventory logic was flawed. A mechanic calls and says, "Hey, I need front brakes for a 2018 Ford F-150. That job requires two rotors, a left and a right, and a set of pads."
Right. You can't just change one side.
Of course not. But Advance might have had the left rotor and the pads, but not the right rotor. Or they'd have both rotors, but no hardware kit to install them.
So the mechanic just says, I can't do the job with half the parts, and immediately calls AutoZone.
Exactly. They fixed that backroom logic. They put in a rule that said, essentially, if a store carries the left rotor, it must carry the right rotor and the matching pads. It sounds so basic, it sounds like common sense, but fixing that kit availability is what drove the entire brake category into positive territory. And remember, brakes are a failure item. You don't buy them for fun, you buy them because you have to.
Let's talk about pricing for a minute. Because one way to juice sales is to just slash prices, but that obviously kills your margins. Another way to juice margins is to jack up prices, but that can kill sales. Where is Advance landing on this spectrum right now?
This is really interesting. Management was very explicit. They stated they are acting rationally. They are not leading the market down in price. They aren't trying to start a price war with AutoZone or O'Reilly.
Okay.
But they also noted their inflation. So the price increases they're passing on to customers was just under 3%.
That seems modest. Maybe lower than inflation in the broader economy.
It is lower than what we've seen from some of their peers recently. But the reason for that is a bit technical. Advance is wrapping or cycling over some pretty significant price investments they made last year. Basically, they already hiked prices or adjusted them a year ago, so the year-over-year change looks smaller now.
Ah, so it's comps issue.
It's a comps issue. But the key takeaway for investors is that they aren't discounting aggressively just to buy sales. They are trying to protect that 44% gross margin at all costs.
Speaking of protecting margin, let's talk about Argos. This is their new private label brand, specifically for oil and fluids. They made a really big deal about this in the presentation. Why does a bottle of motor oil matter so much to the overall strategy?
Private label is the holy grail of retailer margins. I mean, think about it. Previously, Advance was selling a brand that required them to pay royalty payments. And frankly, that previous brand was associated with a parent company that was in pretty public financial distress. It was messy. They were effectively just renting a brand name.
So they were paying someone else for the privilege of selling what is essentially a generic product.
Essentially, yes. By launching Argos, they control the manufacturing, they control the branding, and most importantly, they stop paying those royalties. All of that margin capture now stays in-house. It flows directly to their bottom line.
But will people buy it? Or do they want the big brand name like Mobil 1 or Castrol? I mean, oil is something people can be picky about.
Their consumer testing showed something really crucial about the DIY customer right now in this economy. The guy changing his own oil in the driveway doesn't necessarily need the absolute premium national brand. He wants good enough. He wants reliability and he wants value. Argos is designed to hit that sweet spot.
That makes a lot of sense. If I'm driving a 12-year-old sedan with 150,000 miles on it, I'm probably not putting the most expensive full synthetic oil in it. I want something that works and is cheap.
Exactly. And in a recessionary or, just a tight economic environment, cheap and effective wins. This is a very defensive play against the wallet tightening that we are seeing across the board with consumers.
All right, so we've covered the margin explosion. We have the LIFO benefit, lapping the bad stuff, and actual operational improvements. That explains the pop. Now we have to look at the other side of the coin, the fade.
The fade, yeah.
Because you can have the best margins in the world, but if your sales are dropping and you're bleeding cash, the market is eventually going to punish you. Let's look at the top line. Revenue was $2.0 billion.
Technically, a beat versus consensus, but it was down 1.2% year over year. The business is actually shrinking in dollar terms.
And comps, the same store sales number.
It was plus 1.1%.
That sounds okay, I guess. Positive is good, right?
In a vacuum, yes. Positive is better than negative. But you have to look at expectations. The consensus was for plus 2.2%. So they missed the growth expectation by half.
Out.
And then when you look at the guidance for 2026, They're guiding revenue between 8.48 billion and 8.57 billion. That implies comps of only 1% to 2% for the full year.
So they're essentially telling the market, we fixed the profitability problem, but we're barely going to grow.
Correct. It's a no-growth story for now. But the real killer, the thing that I think really turned the stock from green to red yesterday, was the deep dive into the operations and, most importantly, the cash flow. Let's talk about the operational overhaul first, because it feeds directly into the cash problem. They have been doing open-heart surgery on this company for the past year.
They called it footprint optimization, which is just a fancy corporate way of saying, we closed a ton of stores.
It was a massive reduction, a bloodbath, really. They exited over 500 corporate stores and other 200 independent locations in FY 2025. Just, visualize that. 700 retail locations vanished from the map in 1 year.
That sounds like a company in full retreat.
It looks like retreat on the surface, but the numbers suggest it's actually strategic pruning. They generated about $70 million in operating cost savings just by closing those doors. But here's the really fascinating part. The sales didn't disappear as much as you'd think.
They mentioned sales transfer, right, that the customers went to other stores.
They did. And they tracked this very carefully. When they closed a store, especially on the pro side, serving the mechanic shops, those customers just migrated to nearby sister stores. If you have 2 Advance Auto Parts stores 3 miles apart and you close one, the mechanics just start calling the other one. They're loyal to the parts availability, not necessarily the building. They retained way more sales than expected.
That really speaks to the density they have in their core markets.
It does. They mentioned that even after all those closures, they are still the number 1 or number 2 player in 75% of the remaining markets. They cut the fat, but they kept the muscle.
And now they're actually pivoting back to growth. I saw they mentioned opening new stores.
It's a very modest pivot, but yes, they're planning 40 to 45 new store openings, or NSOs, in FY 2026. But the strategy is what they're calling concentric expansion.
Explain that. What does concentric expansion mean?
It means instead of just planting a flag in a brand new state where they have no logistics, like suddenly opening a store in Montana if you don't have a warehouse within 500 miles, they're building outward from their existing strongholds.
I see.
If they're strong in the Atlanta market, they'll build in the suburbs of Atlanta. It leverages the existing trucks, the existing drivers, and the existing brand recognition. It's a much, much lower risk way to grow.
Speaking of trucks and logistics, the supply chain consolidation numbers just blew my mind. They went from nearly 40 distribution centers down to 16.
It's an incredible consolidation. I mean, can you imagine the complexity of that?
Yeah.
Moving all that inventory, rerouting all those trucks, changing the IT systems. They went from nearly 40 DCs in 2023 down to 16 currently, and they want to get to 15 by the end of 2026.
Why do this? Is it just to save money on rent?
It's rent, it's labor, but mostly it's inventory efficiency. Having 40 DCs means you have inventory spread out all over the place, and a lot of the time it's in the wrong place. By consolidating, they can hold deeper inventory in fewer, more strategic places. But the risk, and this is always the risk in these massive supply chain overhauls, is disruption.
How so?
Well, if one of those 16 DCs goes down because of a storm or it gets clogged up, a huge chunk of your entire network suffers. You have fewer points of failure, but the impact of any single failure is much, much higher.
And to mitigate that, they're talking about these new market hubs. These sound like superstores or something.
They're hybrids, really. A market hub is a retail store, but it has a massive back room. They carry 75,000 to 85,000 SKUs. A normal store might carry significantly less than that. These market hubs act as mini DCs for a local area. They serve 60 to 90 surrounding stores with same-day delivery.
So if I'm at a small store in a suburb and I need a rare alternator for a 1998 Saab, the market hub drives it over that afternoon.
Exactly. It allows the small stores to stay small and efficient with their real estate while still having access to the long tail of parts that you don't sell every day. They're opening 10 to 15 new market hubs in 2026. This is the hub and spoke model on steroids.
Let's talk about the people in the stores, the red shirts, as they call them. Management mentioned rolling out zebra devices. I'm assuming they're not talking about zoo animals here.
No, these are the handheld scanners and computers you see in a lot of retail and warehouse environments now. The goal is pure efficiency. They want to reduce the administrative burden on the store employees. Management said they want the red shirts spending time with customers, helping them find the right part, not stuck behind a counter typing on some old DOS computer.
And they have a specific metric they're tracking for this, time to serve.
Yes. The target is under 40 minutes for a pro delivery.
Under 40 minutes, that is fast.
It has to be. You have to understand the mechanic's business model. If a car is on a lift at a mechanic's shop, that bay is blocked. It cannot generate revenue from another car. The mechanic is losing money every single minute that car sits there waiting for parts.
Right.
So if Advance can get the part there in 30 minutes versus AutoZone getting it there in 60, guess who gets the call next time? Speed is the currency in the pro business. It's everything.
Okay, so we've covered the good, which was the margins, and the hard work, which is the operational overhaul. Now we have to look at the ugly, and that is the cash flow. We hinted at it in the intro, but this is the elephant in the room. A negative $298 million outflow in free cash flow for 2025. That is a lot of money to burn for a company of this size.
It is. And for investors, cash flow is truth. Earnings like that 86-cent EPS number can be massaged with accounting estimates like LIFO.
Yeah.
Cash is either in the bank or it isn't. And right now, the bank account is draining.
So where did the money go? If they made a profit on paper, why is the cash gone?
It went a few places. First, the restructuring itself cost a lot of cash. They had to pay out lease terminations for those 700 closed stores. They had to pay severance to employees. That was about $140 million right there. So roughly half the burn was just paying to fix the business.
Okay, one-time costs. I can sort of forgive that if it's over and done with.
But the other part, and this is the bigger, more concerning part, is the payables issue. They reduced their usage of supplier financing from $2.7 billion down to $2.5 billion.
Okay, stop right there. Supplier financing. We need to explain this because it sounds like boring banking stuff, but it's actually critical. It's almost like a performance-enhancing drug for retailers, isn't it?
It is absolutely a drug, and they were addicted. Here's how it works. Advance buys $100 million of parts from a vendor. Let's say it's Bosch. Normally, you'd have to pay that bill in, say, 30 days. But with supplier financing, a third-party bank steps in. The bank pays Bosch immediately. Then the bank turns to Advance and says, hey, you don't have to pay us back for 360 days.
So it's a massive, basically interest-free loan for a full year.
Exactly. It allows Advance to sell the part, pocket the cash from the customer, and then use that cash for months and months before they ever have to pay for the actual inventory. It artificially inflates your cash balance. And for years, Advance was addicted to this. They had nearly $3 billion of this financing on their books. And now they're unwinding it. They reduced that financing balance from $2.7 billion down to $2.5 billion.
So they are choosing to pay the bank back sooner.
Yes. They're shortening the leash. Instead of holding onto the cash for 360 days, maybe now they're paying it back in 300 days. That difference, that is hundreds of billions of dollars of cash leaving the building earlier than it used to. And that creates a massive cash outflow on the statement.
But why would they do that? I mean, why pay early if you don't have to? Why go through that withdrawal? It seems self-inflicted.
That is the million-dollar question. Or, in this case, the $200 million question. Management claims they are leveling payables based on their new purchase mix. They swear it's voluntary. They insist their vendor relations are the best they've ever been.
But you're skeptical. I can hear it in your voice.
The market is skeptical because usually when a retailer starts shrinking their supplier financing, it's not because they want to. It's because the banks or the vendors themselves are getting nervous. They look at Advance's struggling balance sheet, they see the turnaround, and they say, you know what? We aren't comfortable giving you a full year to pay anymore. We want our money in 90 days.
It's a credit squeeze.
It feels a lot like a credit squeeze. Now, to be clear, we have no definitive proof of that, and management denies it, but the effect is exactly the same. When you are burning cash to pay down your vendors, it restricts your ability to do everything else. You can't buy back stock, you can't increase the dividend, you can't invest as heavily in growth. You are running on a treadmill just to pay for yesterday's inventory.
And looking at the guidance for 2026, they're projecting positive $100 million in free cash flow.
Which, I mean, is certainly better than negative $300 million.
Yeah.
But you have to put it in perspective. On $8.5 billion in sales, generating only $100 million in cash. That is razor thin. That is a margin for error of roughly 1%.
And they are raising CapEx at the same time, right?
Yes. Capital expenditures are going up to around $300 million to pay for those new stores and the IT upgrades like the Zebra devices. So they have to spend money to grow, but they aren't generating much cash to spend it with. If they miss on sales by even a fraction, or if margins dip, that $100 million free cash flow projection could turn negative instantly. And that is why the stock faded. The leash of cash flow is very, very short.
Okay, let's zoom out a bit to the investor context. The whole macro picture. We have two very different customers here, the pro and the DIYer. And it really sounds like a tale of two different economies.
It absolutely is. The pro business, the professional installers, the mechanic shops, that was the bright spot. Comps were up 4% in Q4.
That's healthy. I mean, that beats inflation. It shows real growth.
It does. And it validates that whole time to serve initiative we talked about.
Yeah.
If you get the parts there fast, the mechanics will buy from you. But the DIY side, that is the struggle. Comps on the do-it-yourself side declined low single digits.
What is happening with the DIY consumer? I always thought that in tough economic times, people would fix their own cars more to save money.
They do, for emergencies. But we're talking about the low to mid-income consumer here. These are the folks who are getting squeezed by rent, by grocery prices, by car insurance premiums. They are completely tapped out. When money is that tight, they pull back on everything that isn't absolutely essential.
But fixing a car isn't discretionary. If your car doesn't start, you can't go to work.
True for the failure items, the battery, the alternator, but think about the maintenance items, the funny noise the car is making, the check engine light that's been on for the last 6 months. They are ignoring it. They are deferring maintenance. If the car still drives from point A to point B, they turn up the radio to drown out the noise and they just keep driving. That is why DIY sales are down.
And Advance is trying to combat this with their loyalty program relaunch. They're changing Speed Perks to Advance Rewards. Was Speed Perks broken?
It sounds like it was inefficient. They mentioned specifically ditching the fuel rewards component. Apparently, giving people gas discounts was just too expensive for Advance, and, more importantly, it wasn't actually driving loyalty to their stores.
That makes sense. Gas is a commodity. Getting 10 cents off a gallon at Shell doesn't make me feel loyal to a brake pad store.
Exactly. The new program is a more traditional tiered system, offering coupons up to $100. It's a classic gamification of spending. Spend more, get bigger coupons. It's designed to lock in that DIY customer, so when they do finally have to fix that check engine light, they choose Advance over AutoZone to get the reward points.
Management also reiterated a medium-term goal that really caught my eye, the 7% operating margin. This seems to be their North Star.
It is. But let's look at the glide path to get there because it's steep. For FY25, they just finished at 2.5%. The guidance for this year, FY26, is for 3.8 to 4.5%. So they need to jump roughly 130 to 200 basis points this year alone.
That's a huge jump in 1 year.
It is. And then for FY27, they're already commenting that they expect another 100 basis points of expansion on top of that.
So you go from 2.5 to maybe 4.5 to 5.5. I mean, getting to 7% seems like it's still years and years away.
It is. And the market knows this. Management is forecasting these gains to be back-end weighted, meaning they're coming from supply chain productivity that hasn't actually happened yet. The market is fading the stock because they are skeptical. In a softening consumer environment with DIY sales falling, hitting a 7% margin is an incredibly steep hill to climb.
And we can't ignore the other macro risks. Tariffs, for example. We're in a world where trade wars can start with a single tweet.
They're assuming 2 to 3% inflation for 2026. But tariffs are the big wild card. Management said they successfully negotiated tariff-related costs in Q4. Basically, they forced their vendors to eat some of the cost or split it with them. But if new broad tariffs drop in 2026, say, a 10% blanket tariff on Chinese goods, that could completely blow up their margin model. It's a real risk that isn't fully priced into the stock.
Okay, we have dissected the numbers. We have looked at the good, the bad, and the very ugly cash flow. Now, it is time for everyone's favorite segment, the part of the show where we take all this data and we get a little creative.
Oh, boy. I see the look in your eye. I know where this is going.
It is time for the This Is Not Financial Advice segment. And remember, listeners, we are just two voices on a podcast. We are not your financial advisors. We are effectively gambling with logic here, so please do not do this. But based on this transcript, I have a trade idea. I am calling it the weather hedge battery arbitrage.
The weather hedge battery arbitrage. That sounds incredibly dangerous. Okay, pitch me.
Here is the setup. It's a pair trade. We go long Advance Auto Parts, ticker AAP, and we go short a basket of new car dealerships, companies like Lithia or AutoNation.
Long the parts, short the new cars.
Yeah.
Okay. Why?
Listen to the transcript. Management kept talking about failure items, batteries, alternators. They sell well even when discretionary spending completely dies. I believe we are entering what I'm calling a deferred maintenance supercycle.
A deferred maintenance supercycle. I like the branding. It sounds very official.
Think about it. The DIY consumer is broke. We've established that. They cannot afford a $50,000 new car at an 8% interest rate. So what do? They short the dealers. They don't buy the new car. Instead, they keep their 12-year-old Honda Civic running. And what does that Civic need to survive? It needs cheap oil. Enter ROs.
So the poverty of the American consumer drives them directly to the private label oil aisle at Advance.
Exactly. And here is the hedge part of the trade, the weather. The transcript mentioned that failure items spike in extreme weather. So if we get a polar vortex this winter, car batteries die. Advance sells a ton of batteries. They win.
Okay.
But if we get a mild winter, the economy is still tough, so people are still buying cheap Argos oil to keep their old cars alive. So if it's cold, AAP wins on batteries. If it's a recession, AAP wins on oil and on the fact that people are not buying new cars.
So you are hedging temperature against economic depression.
Precisely. It's a beautiful thing. We leverage up on call options for AAP, specifically dated for after the winter earnings report, and we finance the whole thing by selling puts on luxury car dealerships. It is the ultimate old car survival trade.
It is absolutely outrageous. It assumes that the American consumer will never buy a new car again and will just keep pouring cheap oil into rust buckets forever.
It's a bet on grit and rust and the incredible resilience of the American beater car.
It is definitely a bet on something. But please, listeners, do not do this. This is effectively just gambling on the temperature and the poverty of the American consumer.
But it makes you think, doesn't it? It really highlights the counter-cyclical nature of the entire auto parts business.
It does. When times are tough, people fix cars instead of buying new ones. That is the fundamental truth of this entire sector.
Exactly. All right, let's bring it home. Conclusion time. What is the final verdict on AAP's Q4 2025?
I think it was a profitability shock, but a growth dud. That's the simplest way to put it. They absolutely shocked everyone by fixing the middle of the profit and loss statement. The margins look great now, but they haven't fixed the top line, and they certainly haven't fixed the cash flow statement yet.
So the turnaround is happening, but it's messy. It's not a straight lineup.
It's extremely volatile. Management is basically asking for patience through 2027 to hit that 7% margin target. But the lack of free cash flow is the leash that is holding the stock back. Until they print cash, real distributable cash, the stock's going to stay in the penalty box.
So the show me sentiment remains firmly in place. They showed us the margins, which is great.
Yeah.
Now they have to show us the money.
Exactly. We'll see you next quarter to find out if Argos saved the day.
And that's a wrap for this deep dive into Advance Auto Parts. Thanks for listening to Talk Tickers. Remember, do your own research, read the filings, and we will catch you on the next print.
Thanks, everyone.